G'day, I'm Nick Erner. I'm the Managing Director of Alkane Resources, an Australian listed gold producer and explorer. Good to see you, mate.
Nick, good to see you. Good to see you. We saw you, I think, down at Colorado Springs in the US back in early September. You since then, you kind of put out the kind of quarterly activities report, and it seems to be, steady as she goes.
Very much so. And in fact, with the recent gold price increases, even slightly better than we thought we would go in terms of cash bill. We had pretty much a neutral after all the capital spend and everything, very close to neutral cash quarter, and our projects remain on track. So yeah, for us, fantastic. I guess, for the average person, a little bit unexciting, but unexciting could be good.
Well, there's the thing, Nick, having sort of seen a few kind of disasters this year in Australia, in Canada, in the US, in terms of things that can go wrong. Steady as she goes right now, and taking advantage of these high price gold environments is more than good enough, quite frankly. So can we sort of just talk about through some of the things that you are doing? Obviously, margin looks like what at the moment?
So margin at the moment, our all-in sustaining cost was sort of 22.50 Australian, right? So we didn't change our guidance. We're 2,400 to 2,600 Australian per ounce for this financial year. And the reason for that is, people will recall from our last conversation, we're doing a whole heap of development because we're in this new mining area. We're mining up and down. We're really opening up multiple mining fronts at present, but that falls away. All in sustaining costs will be probably 2,000 Aussie next year. So yeah, margins are very, very solid. We have a hedge. We have a hedge book. And that hedge book we took out when we took out debt over a year ago. But that hedge book basically means if whatever the spot price is, we get about 90% of that when it averages out. So, so at 4,000 Aussie, we're getting 3,600 in the hand for that hedge book. So really decent margins, even while we're doing a lot of development at the moment.
Right. I think the usual cry at moments like this is when the markets are good is like, why the heck would you put that hedge in place? You should be capturing all of the upside. But I guess the markets don't quite work like that. How long is that hedge in place for? Yeah,
so we put the hedge in place in April 2023, right? So, the hedge went in place at the price that was at the moment, which so it's an average of about 28.40 Aussie. And it's pretty much about 35% of production through to June 2027.
Right. Okay.
So it's in place for another, 2.5 odd years. We've got 81,700 ounces to go to pay into that hedge, which is, as people do the maths, they'll work out. That's why I say we pretty much get 90% of spot on every ounce.
And just again, let's talk to this because, like I say, people always like to grumble about the fact that you're not taking all of the upside here. Going forward, once that hedge is gone, would you continue that type of approach to mitigating risk going forward, or would you like to sell it?
If let's say if we were taking out debt today, right, for some value accretive purpose, we would put some sort of financial protection mechanism in place. Right, people need to differentiate between an open investor, right, so a shareholder who has the right to buy and sell at any time. So if they see, actually this financial circumstance looks a little bit weaker than I thought, I'm going to sell my share, right? And whereas people running a company, our job is to keep the company running, right, and make a profit for all shareholders, not
opt out.
We don't leave open downside risk, so we would have that.
Yeah.
But to answer your question more specifically, so we always have typically in the past had like a rolling 1 year hedge mechanism, right? So that, let's say, we're recording this just before the American election, nearly as exciting as the Melbourne Cup here in Australia, but not quite. There'll be turbulence, there'll be volatility. And we know that during rapid market sell-offs, when they come, people often sell gold because it's a liquid investment, right, in gold stocks. And so, you need to be able to ride through those short troughs that occurs, which is why you tend to have like a rolling hedge. But of course, come June 2027, we'll review what it is. There's no need for any massive downside protection if your margin, if we're making it 2,000, we're selling for 4,000 and you might correct down to 3,000, well, you don't really need to protect it. You need to protect yourself at 2,000, right? So we'll look at whatever financial metrics are warranted at the time of June 2027, but people should, I think, always expect some sort of downside protection from us as a company, because think that's prudent.
Okay, and sticking with the kind of political theme of, governments have got choices to, cut costs or invest for growth. Likewise, you, in terms of like looking at what additional costs can you cut, and then what can you do with your capital for that growth story?
In terms of us, yeah, so we, our growth story is pretty well publicised and articulated in that we're at the very, very tail end. We're commissioning right now our paste plant and our flotation and fine grind circuit. One, to get full ore recovery from our new deposit Roswell, and the other to improve the recovery from the ore that we get, right, which is the flotation and fine grind. So then we have upcoming capital of approximately $50 million Australian to move the Newell Highway, so the highway that runs over the top of Roswell and San Antonio deposits, in order to get an open cut and then a kilometre to the west. We have sort of $35 million for an expansion of the plant, right? And then we have sort of $15 million of pre-strip infrastructure establishment and stuff like that. All of those could slide in let's say the price was incredibly tumultuous. We could slide all of those things, months or quarters if we need to, because of course we're producing at an approximately 80,000 ounce run rate from the underground, right? But we are of course minded to go and execute those, and with the current price where it is, the cash flow generation that we get is more than sufficient to pay for that and still get a return, and it of course releases the 180,000 plus ounces that sit in the San Antonio open cuts. So in terms of other discretionary costs, we're sort of only spending $6 million now across our portfolio. That's our exploration budget this year. We think that's prudently applied. And outside of that, the rest is just going into the expansion and execution of the plant, like I talked about.
Right. Okay. And can we come back to the kind of the cost cutting exercise? Because people look at you and they go, "Oh, great. That's a problem, right?" But you're obviously managing to make margin there with the process, efficient engineering, and all of that kind of good stuff. Is there much more on the cost cutting side that you can do to improve that margin?
Not particularly. On our metrics, on sort of your typical mining metrics, we make quite high productivity from our loader, truck and haul fleet, blasting costs, processing costs. Australian electricity prices are not dirt cheap. We pay in the mid-teen cents per kilowatt, whereas versus any Canadian lists would be like, what, our hydro's 5 to 8 cents. So that's different. So there are modest things, and of course you can do I call it insensible things in a crisis, but not if we saw price retreat from 4,000 to 3,200, our plan would be pretty much exactly what it is at present.
Right. So growth is the focus. Increase the amount going through and expanding the resource. So, what do you think the potential is here? Because we've talked in the past about obviously the road build, and that's going to be starting next year, presumably finished by the end of next year. And they'll kind of give you a lot more to get after. So. Talk about that, because I kind of want to get on to kind of M&A activity which we're seeing across the space and how you come at that. But first of all, your own expansion plans, please, whether it be through exploration or otherwise.
Yeah, so if you look at our expansion plans, we road increasing our throughput lets us move from this 80 to 100,000 ounce run rate, right? So we think that's a sensible allocation of capital, barring other places we could put it, right? So we also put a lot of money in, several millions of dollars. We are open at depth underneath our Coloma pits, so the eastern pits where we already have an underground mine operating. We're open at depth underneath the Roswell, and so it'll be another year and a half before we get deep enough to set up a decent offset drill position for that. And we're open at depth under the San Antonio deposits, where we're going to put the open cuts. At the moment we're drilling holes under those deposits, looking for resource extensions, hundreds of metres below the pits. And as well as that, to the south, and we're moving the highway already around this in preparation, we already own the farmland in preparation. We have deposits called El Paso, which we think have underground potential. So that's where we're putting, I'll call it, brownfields, brownie greenfields, extension on that. Because we already have a mine plan that goes out into the early 2030s. The project is approved to 2032. It's it's a much simpler process of approval to get that extended in mine life. We have the tailings dam capacity to extend it particularly with the pace coming online. So all of those things are things that we look at to extend and improve the mine life. The logical question that someone might think is, well, like, why don't you just expand? Why don't you double production? We're still underground mining. We don't think that the ounces per vertical metre that we can release means that we could significantly expand production beyond where it is. If we found a whole satellite mine deposit somewhere, maybe, but that's not something that's in the pipeline for us at the moment.
Right. So you feel like kind of optimize or getting quite close to that point where you sort of optimize what you've got today, and you're building up cash reserves. To what end, right? Because you're sort of that sub 100,000 ounce category, right? You're close, but not there yet. And I think
exactly.
There's a mental sort of barrier there at that level. And we're seeing a lot of M&A, some of it good, some of it not so good, some of it expensive, some of it not so expensive. And there's not a lot of good stuff out there, right? So how should your shareholders look at this? If you're building up this cash, can they expect to see stuff, either share buybacks, dividends, or do you think it makes more sense to actually go and increase those ounces, get over that kind of mental barrier through acquisition? How do you play it?
Yeah, so to be pretty clear, because this is something that we've discussed about, what I've been said in quite a few of my presentations. I and our board are of the view that a single mine asset like we have, a single mine company like we have, remains at risk from both external shock, but also suffers quite wide variations in valuation through its own asset cycle, right? Depending whether it's generating cash or it's spending cash. And so certainly it's much less risk to be a multi-mine producer, number one. And number two, there's a real, whether we like it or not, there's a real factor that size and scale increase liquidity and therefore increase investment. It means that different funds, you have a minimum investment criteria, you're accessible to those funds. Whereas now, our daily liquidity is sort of circa $700,000, right? So if you're a fund who, would like to put in a $10 million position, which is not an unreasonable position for a fund at all, it's going to take you ages. So you just won't look at us. And we've been very tight with our register. We haven't done any capital raising since 2019. So there's just no entry points for a fund like that, right? So, however, if you're 2-3 mines, you simply do have higher liquidity. You have more index funds, and therefore you just get more turnover, right? So people can assemble positions. So that means, of course, we remain very open to M&A. We've tried to take investments in other small companies and force something we've made money, but without great success before, and we would love to do that again. But as you point out, Matt, it's finding things with the right valuation, the right mindset, people that share that view. Exactly. So, but we would see that as like a scrip type transaction, right, rather than a cash transaction. If we look at FY26, so starting from in the middle of calendar 25, we'd follow the typical Australian financial year from mid-year to mid-year. We should be generating a lot of cash in that period of time. And one of the things the board will crystallise, certainly by the end of next financial year, is what's our capital return strategy, right? Even if we did investments in another company or merged with another company or took over, had a development project, we're very like-minded in the thinking that we need to have a capital return strategy, whether it's dividends or buybacks at a certain portion, because the amount of cash that, if prices stay where they are, that ourselves and other companies will be generating is just going to be phenomenal. And we can see why shareholders want some of that back. And so we'll be looking to create some sort of balanced thing. There's a certain amount that goes into growth, a certain amount that goes into, increasing your corporate balance sheet strength, and a certain amount that gets, returned back to shareholders. But as to the makeup of that, we're more interested in, sorting that out once we've, delivered and we've got a clear view of what the price is.
Right. So it sounds like, okay, you've got your eyes on the horizon, but at the same time, there's a lot of the head down and actually, deliver on all of these things.
Yeah.
Yeah, I mean, do you know what I mean? It's kind of like you said it so steady as it go at the beginning, but that it kind of feels like that. But we also kind of want to see what do you think that moment's going to be where there's this sort of step change and reaction in the share price, because it's been sort of sideways for the past few years, and like it's been a tough market. I'll give you that.
I get asked that a lot by shareholders, particularly retail. We are a predominantly retail shareholder-driven company. So I think it's only a matter of time for people to recognise the free cash flow of the business. So if you look across the ASX, people making 80-odd thousand ounces and all have different projected growth profiles and all that sort of stuff. But people generating, that circa this $40 to $100 million free cash, they carry valuations in excess of 500 million Australian, all the way up to sort of 2-point-something billion Australian, right? And like I said, all have different growth prospects and margins and stuff like that. So what we're seeing more and more in Australia is just further and further down the market cap list, people are realising and recognising that cash flow, and that's starting to respond in the share price, right? So we feel there's a certain inevitability about that for ourselves. And what we need to do is show people that cash is coming, all right, and show that cash is here, and show that build up. December quarter, the one we're in right now, for us that should be cash flow neutral to cash flow accretive as a quarter, and that's the second quarter in a row where, despite pouring money out on development and both sustaining and expansionary capex, we haven't drawn our debt facility further, and our cash balance hasn't gone down. So people are starting to recognise and see it. We've had some recent share price moves. I've come from talking through Australian funds in Sydney, Melbourne. People recognise that. People recognise that we're undervalued on nearly every peer comparable that there is. So, I don't know when it'll be, but it may end up being even after the March quarter, right? When our cash balance goes up as much as people with a market cap 6 times ours.
Okay, I'm always interested in the kind of, no one's going to mark you down for not being able to produce. You're producing at good margins, and the operations are running smoothly for now. We'll say.
Yeah, there's always a risk something very unforeseen could happen. But yes, exactly.
There is, and I think one of the things, potentially, and you kind of referenced it already in this call, which is like, what will the markets do kind of post the US elections, depending on who wins? Is it more of the same? We've had a really good year. If you look at prices, this time last year, wow. I mean, just absolute wow. But what are your expectations around that? And do you think you're sort of protected?
It's very difficult to say, isn't it? Right? And there's as many opinions as there are citizens on the planet, really. But what do we know? Well, the first thing that's really happy for us is, even though our hedges are out of the money versus spot, they're in the money versus our cost of production, right? So that's fantastic for us. You can read widely, both US presidential candidates and their parties. Neither of them, outside of the comments made by Elon Musk, right? Neither of them seems to be looking to change the amount of government spending. If you look at their promises. So certainly that would appear negative for debt and negative for potential inflation in the States. High inflation, typically bad for gold, right? But, that's a difficult thing. Instability is typically good for gold. As we talk, as well as that, we've had Iran say they're going to give a complex and decisive response. I mean, who knows what that means, but it doesn't sound positive. You've got North Korean troops, reportedly arriving on the Ukraine border, together with Russia. None of this says the world is flat, smooth, less turbulent, more reliable, and therefore gold as a bastion of value should be now discarded as we retreat to the US dollar, right? And so it's typical to see swings of 10 to 15%. And you've got to remember, at this value, 10% would be $415 Australian, right? It's 41.50 Aussie, right? So, a swing down to 3,700, you'd hear people saying the world is ending, right? And it would only be a 10% swing. But if you'd have told me a year ago that the price would be 3,700, I felt like it could be, but I'm very excited, right? So, I expect to see both volatility and higher gold prices And I can't see any reason for the US dollar to surge outside of conflict safe haven, despite the lack of fiscal logic in the safe havenness of it.
I think you're right. The next few days will be fun. And at the very least, TV gold, watching the elections in the US.
Yeah, I think as non-US citizens, we all have a somewhat macabre fascination with it because we understand the ripples that it gives out on us. But for us as a gold mining company, yes, it will affect the revenue side. But in Australia, costs have stabilised. Despite the high margins, you and I've chatted before. I don't see a lot of supply response really available either.
That's really interesting. That's an interesting point because you think in this environment it absolutely should. But what's happening is mergers of equals. It doesn't change the production profile anytime soon. You might get some efficiencies, that's the hope. But the reality is the companies are trying to make themselves more attractive to some of these indices by getting over that, whatever that threshold that each indices has. It's not necessarily about brand new production. And I think developers, certainly I'm looking in North American market, you've got 5 million ounce developers who just aren't getting the valuation. They're sitting around 100 million US or 100 million Canadian, even worse, and the funding isn't there for them. So I think you're right. If you're in production right now, you're in a good place.
Yeah, you're in a good place. And people, it's widely acknowledged that the Australian retail market is pretty mining. I call it savvy, but prepared to invest in mining stocks. Whereas some of that's retreated a little out of the TSX, by all accounts. But even here, developers struggle to get valuation. People can get a really lofty valuation on an exploration story where stuff runs and people are excited and stuff. But once you move into, I want to develop it, there's plenty of people with projects that have an NPV of 400, 500, 600 million bucks, Aussie, US, whatever it is, whose market cap's, as we say, around 100. And then, of course, people say, well, how are you going to get that funded? That's too dilutive, and you're locked in this catch-22. And then I also read pundits saying existing producers should be buying ounces, not developing. But someone has to develop the ounces. We've always thought, if you're not prepared to develop the ounces yourself, why would anyone be prepared to buy your ounces, right? So we're very minded to develop. And a lot of the heat has gone out of the mining construction market here in Australia. So you could develop with reasonable surety of pricing, provided your permitting was taken care of. Your water, your other things. Labour is, men and women in the mining industry are still in demand, but we're not so in demand that we're impossible to find. There's been retreats in some of the critical mineral stuff. But globally, I just don't see massive demand response. Not within China, not even within Africa. So
the other factor here, Nick, to think about is the fact that these companies have been kind of cash starved for the last 4 or 5 years, right? So they've had to change the business plan, and the business plan is let's go from a big idea down to a smaller idea because I can't get $400 or $500 million capex to finance this thing, but I might be able to get 100. So therefore, the ounce profile there is significantly smaller. I'm talking anywhere from 20 to 40 thousand ounces, which is very different from the 150,000 ounce level that you get with the larger capex. So it's less efficient, it's less ounces, but again, it comes back to your point. There's not a lot of ounces, and that kind of response to the market is just not there. Producers, it's your time to take advantage of this.
Oh yeah, absolutely. And then, like we talked about earlier in the conversation, of course, when producers take advantage of it, shareholders quite rightly say, what are you going to do with that cash? We'd like some of that back to allocate for our portfolio. So I do think it's likely that we'll see, dividends and buybacks increase through the gold sector. You would think.
You'd think. Well, it kind of informs retail perhaps where they need to be looking right now. And I'd point heavily towards, maybe significantly advanced developers, but definitely producers at the moment. That's where the next, I think, 6 to 12 months.
Yeah, and particularly, producers like us who are potentially going through a value inflection point and have not yet been re-rated. Like, there are other people like us out and about, and I think they're coming onto people's radar, and, all that stuff moves pretty quickly because there's not a lot of liquidity and volume there.
Well, Nick, I agree with you. And I look forward to seeing how you can move these things forward. And like I say, we'll see what happens after the elections, but long may the gold price continue to do its thing for us. Appreciate your time. See you soon.
Thanks, Matt. Thanks.